Hello, everyone. Thank you for joining us for today's webinar, Mid-Year Accounting Update. For those of you requesting a copy of the slide deck that we're about to go through, not to worry, I'll be sending that out within 48 hours of the webinar for your reference and safekeeping. So a few housekeeping items to go over before we get started. You can maximize or minimize the webinar pane during the presentation by using the red/orange arrow buttons. During the webinar, we also encourage you to ask questions. You'll see a questions box that you can use. Just type in your question and click submit. Our presenters will answer those questions as time allows. If we don't get to them for any reason, we'll be able to follow up with you after the webinar. Now, a quick note on your audio settings. If you're using a telephone, please click on the phone call audio option. If you're listening through your computer, then please click on the computer audio option. Now, a quick review of CPE requirements. For CPE, you must use a personal computer, no smartphones, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. There are 4, which means you need to answer 3, and you must complete the evaluation survey following the webinar. Now, a quick intro to our presenters. First up is Matt Peralt. He is an audit partner in charge of our firm's SEC and technology practice. He has more than 20 years of experience and works with SEC and tech audit clients, has supported more than 30 international technology sector transactions, including IPOs and M&As. Prior to joining the firm, he was with EY, working in their technology and insurance business services practice, and also spent time as a controller and VP of finance within industry. Next up, we have Jeff Owens. More than 16 years of experience in public accounting. He is an audit partner in our Dallas office. He focuses on serving the technology, nonprofit, and private education sectors, where he helps clients keep up with the accounting and tax regulatory environment, as well as maintaining strong financial reporting processes and internal controls. Finally, but not least, is Robert Gonzalez, principal with our audit practice in Dallas as well. He leads our qualified plan assurance services practice in Dallas and has more than 27 years of public accounting experience. He's instructed and presented on qualified plan auditing at the national, state, and local levels, and has served as an AICPA Employee Benefit Plan Audit Guide Revisions Subcommittee member. He has also led employee benefit plan audit practices at large international firms within the Big Four accounting group. Finally, we've got our learning objectives. What we're going to talk about today. We're going to analyze the impact of recent issued accounting standard updates on private and public companies, review the background, highlights, and application of those ASUs, identify when companies need to adopt and apply each new standard, and discuss recent and ongoing projects. And with that, I'll turn it over to, well, we've got more of an overview here, so we'll skip that, and we'll turn it over to Matt.
Thanks, Deb. Yeah, so in determining what to present today, we recognized that there was limited time for the participants, and so we intentionally culled out revenue recognition, obviously 606, leases, and accounting for financial reporting framework for nonprofit companies. All those have been covered under separate webinars, so just keep that in mind as we go through today's presentation. So the first topic we're looking at is stock compensation and modifications of any type of stock option awards. So this ASU was written to further clarify what qualifies as a modification. And the reason that that needed to be written is that there was some diversity in practice. When folks were modifying stock option awards, there was folks were differently determining whether that modification to the award was substantive or purely administrative. And there was no guidelines. If you look through the ASC code 718 on this, there really is no definition around what constitutes a substantive or an administrative change. And so the FASB took this on to basically eliminate that diversity in practice. And effectively what this new standard says is that any modification that you make to any stock option award, if it's a restricted stock, if it's a stock option, unless these specific 3 criteria are met, that modification should be accounted for, disclosed, and basically you need to rerun the fair value calculation to determine what is the incremental compensation. So walking through each of these 3 criteria, First, basically take a look at the fair value of the modified award 1 day before the modification. So if you're running a Black-Scholes model and you ran that to calculate the fair value of the stock option at the date of award, you now need to update those assumptions for, again, day before the modification, rerun the fair value of that award, and then compare it to the modified award. And some of the instructions here in the ASU specifically state, well, if there's no change to any of the inputs in the model, then you don't even need to run the model. So obviously, if you're thinking about a Black-Scholes model, what are the common inputs to that? It would be the fair value of the common stock on the date of the award, so that's not going to change. Interest expense, life of the award. So again, you don't need to rerun it if obviously none of the inputs to that model are changing. Second criteria to make sure that you're not needing to account for modification would be to make sure that the vesting of that modified award has not changed, that it's the same vesting term as the original award. And then finally, take a look at the balance sheet classification. If you made a modification to that award and the accounting guidance took you from equity to liability treatment, or vice versa, if the award was accounted for in liability, and now, because of the modification, you may look at equity treatment for that award, then that constitutes a modification, and you do need to go ahead and make the calculation of that fair value. So again, this doesn't change the way that fair value accounting is dictated for the original award, nor does it change the treatment of a modification. It's really just determining what is in scope for a modification. This standard is going to roll out effectively any fiscal years beginning after December 15, 2017, so that's next year, January 1, and early adoption is permitted. And one final thing I will say on the standard, keep in mind that when you rerun those fair values, you need to take a look at the vesting that is expected to occur on that modified award, and that's going to be factored into the incremental comp that you need to calculate when you're looking at these modified awards. Next standard, we're taking a look at ASU 2017-04, and as we look through these standards, I would say there's three basic reasons that the FASB issues new standards: is either to simplify, to eliminate inconsistencies, and in other cases to enhance the financial statements to give more information. And for you preparers, the latter is the worst case scenario, where all of a sudden you have to invest more time. I think this is a good standard in that it does simplify the testing for goodwill impairment. And one of the reasons, principal reasons why this was issued, if you may recall, back in 2014, FASB put out a pronouncement that allowed you to take goodwill and amortize that over a period of 10 years. And also in 2015, a second standard was released that allowed certain acquired customer intangible assets, if there wasn't the ability to separate those things contractually, then you could just dump those into goodwill and also amortize them over 10 years. And so it made the accounting simpler in terms of goodwill, but the annual impairment testing was still burdensome, and so that's why the standard was written again to provide additional relief. And so as you step through the methods for evaluating goodwill, you are allowed to do first a qualitative assessment of whether or not there's impairment, and so that hasn't changed. You still have the option to do the qualitative only assessment, but if that qualitative assessment says that there is an indicator in impairment, then you have to go to step 2, which is the quantitative assessment. And so the first component of that is just comparing the fair value of the reporting unit. So in this case, if you're thinking about an acquired business unit, you would take the net assets fair value of that, you would take the book value first and then compare that to the fair value. But unfortunately, if you did that step and the book value was in excess of the fair value, then you needed to go to step 2, which basically said, okay, now let's calculate the implied fair value of goodwill for that reporting unit. And what that effectively required you preparers to do was re-fair value the entire balance sheet of that reporting unit. and that included in-process R&D. If you had inventory on your books, you had to re-fair value that, all to arrive at goodwill. Then you compared that goodwill on an implied basis to what you were actually carrying at it and did the calculation. So effectively, this new standard eliminates that step 2. So all you need to do under the new standard is take the fair value of the entire business. So you only need to run one set of cash flows for that entire business. You don't need to allocate it down to its individual elements. Compare that to the book value of the entire reporting unit. And then if there's a difference, then that is the amount of impairment, and that is what you should record to goodwill. But again, for purposes of simplification, the impairment charge that you're recording can't exceed the book value of the goodwill. And then one other thing that ASU added here was just to eliminate both the qualitative and quantitative steps for any reporting unit. If you have a 0 or negative net carrying amount, so that if the assets are exceeded by the liabilities on that balance sheet for that reporting unit, then it effectively says you don't need to do any sort of annual impairment testing, because obviously you're carrying that reporting unit at a net negative balance. In this standard, so for public companies, it's going to be December 15, 2019, so effectively January 1st, 20. For public companies that aren't SEC filers, 2021, and then private companies, again, 2021. An important note here is that if you're a private company and you have elected to adopt that standard that allows you to take those acquired other intangible assets and dump them into goodwill, when you're adopting this new standard, you do need to get an auditor preferability letter to show why the adoption of this new policy is preferred. So a little wrinkle there for the private companies that have gone down that route.
Perfect. And now we've got our first polling question for those of you here for CPE. Question 1 is, which type of entity is allowed to amortize goodwill? Is it A, private companies, B, public companies, C, nonprofit or exempt orgs, D, none of the above, or E, all of the above? And again, for those of you wanting copies of these slides, I'll be sending them out within 48 hours of the webinar. Make sure you get those answers in. We'll close the polls in 3, 2, and 1. Looks like we might need a little bit of clarification on this one, Matt.
So right now, under the existing standards, public companies and nonprofits are not allowed that alternative to amortize goodwill over a 10-year period. So right now, that election is only available to public companies. So answer A was the correct answer.
Now over to Jeff.
Great. Well, thank you, Debbie. So the next topic we're going to talk about today is ASU 2016-13, which is measurement of credit losses on financial instruments. So this update was issued a little over a year ago, and it doesn't become effective for a number of years, but it's certainly interesting for those of us who, I guess you could say, fell in love with FAS 5. This is changing it up just a tidbit. So this was issued to provide some more useful information about expected credit losses on various financial instruments that do have a contractual right to receive cash, so things such as loans, debt securities, AR, etc. This all really came to light with the recent global financial crisis that shed some light on some inconsistencies between U.S. GAAP and the needs of financial statement users. So in the lead up to the financial crisis, users were making estimates of expected credit losses and thus devaluing certain institutions. However, GAAP wouldn't allow that same institution to recognize a corresponding impairment loss because it didn't meet the definition of the probable threshold under the existing guidance. So let's look at what some of the main provisions are in this update. So the amendments in this update really affect an entity to various degrees depending on the credit quality of the assets held, their duration, and how the entity applies current GAAP. The revisions replace the incurred loss impairment methodology that delays the loss recognition until it's probable, with one that also takes into account an analysis of forecasted information. Previously, when credit losses were measured under GAAP, an entity generally only considered past events as well as current economic conditions when measuring the potential loss. These amendments here broaden the information that an entity must consider in developing their expectations of credit losses and the related estimates. They are now required to use forecasted information, which hopefully will lead to more decision useful information that the financial statement users can use to make decisions about the company. The current estimation techniques used today will still be used going forward. However, the inputs in those techniques will need to be updated slightly to reflect the full amount of estimated credit losses. So looking at the effective date for public businesses that are SEC filers, this ASU is effective for fiscal years beginning after December 15, 2019. For non-SEC filers but are public businesses, this is after December 15, 2020. And then all other entities, this is also effective in December, or for fiscal periods beginning after December 15, 2020. And early adoption is permitted, but there are some further things to consider there. So moving on to the next topic we're going to talk about the ASU 2017-08 receivables, non-refundable fees and other costs. So ASU 17-08 was just recently finalized by the board and was issued to amend the amortization period for certain callable debt securities that a company holds at a premium. Under current GAAP, entities generally amortize that premium paid as an adjustment of the yield over the contractual life of the instrument. Additionally, entities that have a very large number of similar loans can accurately predict the future principal prepayments when applying the interest method of amortizing those loans. But entities that hold, an individual callable debt security at a premium may not be able to amortize that premium to the earliest call date. This revised guidance changes all that and really better aligns the amortization period of the premiums and the discounts to the expectations incorporated in the market pricing of those underlying assets. So I know I just said a whole lot. So let's talk about the key takeaways related to this update. So the update requires, like I said, the amortization period for a premium on callable debt securities to extend to the earliest call date. And that is very different from current GAAP that requires the premium to be amortized over the contractual life of the instrument. This update is silent on any changes to the amortization period for securities held at a discount. Discounts under the continued guidance will continue to be amortized until maturity. So looking at the effective dates here, for public entities, this is effective for periods beginning after December 15-18. All other entities is after December 15-19. And again, early adoption is permitted. So moving on to our next topic.
Plan accounting, my favorite. So we're going to talk briefly about ASU 2017-06. Simply put, ASU 2017-06 aligns the reporting and disclosure between various employee benefit plan types investing in a master trust. As a reminder, a master trust is an investment vehicle which holds the investment assets of two or more related employee benefit plans. These plans may hold a divided or an undivided interest in the master trust. Currently, master trust reporting guidance may only be found in Topic 960, Defined Benefit Plans, which we'll refer to as DB plans, with just a sprinkle of information in Topic 962, Defined Contribution or DC plans. So most of us practitioners relied on the EBP audit guide to develop master trust disclosures for plan financial statements. This led to confusion and a divergence in practice among practitioners and plan sponsors. Now, this ASU also addresses a redundancy related to plans with 401H account disclosures. You may recall that 401H accounts are created in an overfunded DB plan and used to fund post-retirement health and welfare benefits in a plan sponsor's health plans. So let's get to the ASU. First, under topic 960, a plan's holdings and net earnings in the master trust are shown as a single line item on the face of each of the plan's financial statements. Similar guidance is not found in topics 962 or 965. This ASU changes that by requiring all plan types to include the information on the face of their financial statements as separate line items. Next, current DB and DC plan guidance requires plans to disclose certain master trust level investment and investment earnings information, a description of the basis used to allocate master trust net assets to plans, and the plan's percentage interest in the master trust. This ASU extends that requirement to topic 965 covering health plans, but it eliminates the requirement to disclose a plan's percentage interest in a master trust for plans with divided interests. It also requires all plans to disclose the dollar amount of their interest in each of the master trust general investment types. Now you can find a great example of this disclosure on page 12 of the ASU. Now this third bullet is a new disclosure requirement for plans. All plans must now disclose a master trust other assets and liabilities, such as due to or from brokers for securities purchased or sold, accrued interest and dividends, and accrued expenses. Plans must also disclose the dollar amount of its interest in each of those balances. And lastly, health plans will no longer be required to provide investment disclosures for 401h account assets because those disclosures are provided within the related DB plan's financial statements. But health plans are required to disclose the name of the DB plan holding the 401h assets so that all users can access the disclosure information relating to the 401h account assets if they so desire. This ASU is effective for fiscal years beginning after December 15th, 2018, so we have some time on this one, although early adoption is permitted. But if you should early adopt, remember to apply this ASU retrospectively. Thanks.
All right, thank you, Robert. So now we're going to talk about down round protected instruments. And this was issued as part of the FASB's ongoing attempt to simplify or clarify the guidance surrounding equity versus liability treatment for certain instruments. And you can see just by the title alone of this ASU, it covers a whole lot of things. And every time I've gone to the annual FASB or SEC update, they will tell you the #1 area that we accountants get wrong is equity versus liability classification. And certainly that has big implications, not just because of how it's shown on your balance sheet, but oftentimes when you arrive in liability treatment, that puts you into fair value accounting, and certainly then as you re-fair value those instruments at each reporting period, then you get a charge through your P&L or other comprehensive income. And so, you know, I think it's good the FASB is tackling these things. Certainly, anybody who's been through the decision tree to try and determine whether or not something is an equity versus a liability instrument, we appreciate the FASB's attempt at this and say more. So let's take a look at this standard. So for those of you not familiar or haven't heard with what a down round protection component is, effectively what it says, if you're looking at either convertible debt or a warrant, it effectively says, let's give an example here where at the time the convertible debt was issued, the latest preferred stock was at $10 a share. So maybe the convertible debt has a feature where you can convert that debt into the preferred stock at $10 per share right now, but the way those agreements are written, it'll also contain a provision which says if in the future the company issues another round of equity and that round is cheaper than the current round, then your strike price or your cost to purchase or convert drops. So again, in that example, convertible debt, preferred stock is right now being sold at $10 a share. Maybe a year from now, preferred stock is being sold at $8 a share, well, you can then convert when and if that preferred stock in the future is sold at a lesser price. Basically, the complaint here was that that doesn't affect that doesn't depict the economic reality, that when share prices are declining, the entity actually records a pickup in income because the liability that you initially recorded in a subsequent period, if you issue a down round of equity securities, then that liability value declines and you take a giant gain through the P&L in some circumstances. And so basically folks were saying, hey, this is creating a headache in the terms of the way that we have to re-fair value these instruments, and what it's showing on the face of the P&L just doesn't make sense. Value of the company goes down, we record a gain, and then vice versa, if that has happened and then the subsequent period the value of the company goes up, then they're recording a giant hit to the P&L. So FASB listened to that and they basically said, if you have an instrument that has down round protection feature and that down round protection is the only reason that you arrived at fair value accounting, well, you can now, under the terms of this new standard, disregard the down round protection provision. I know for a lot of my private companies here in the Bay Area, warrants, many preferred stock warrants have this provision, and that's been a pain in the butt for companies just because they've had to re-fair value that warrant at the end of every reporting period. So now you're outside of fair value accounting guidance, but you still have to look to contingent BCF guidance, which is beneficial conversion feature guidance, and you effectively have to record this now only on a when and if converted basis. So BCF, beneficial conversion feature guidance, effectively says look at the intrinsic value, or what the person actually received in terms of a benefit on the date of conversion. So again, if you're converting convertible debt into preferred stock and it was initially done with a conversion price of $10 a share, and you now, the company issues at $8 a share, that $2 a share increment is charged through, and that will be charged through the P&L. I'm sorry, not the P&L, but it will appear as a dividend on the company's financial statements, where you'll basically affect it directly out of retained earnings, so it's not going to run through the P&L any longer. Another smaller component of this ASU that was written is private companies. Previously, there was an exemption provided, or an indefinite deferral for companies. If you had a mandatorily redeemable financial instrument, and most of this guidance was contained in an old accounting series release under the SEC ASR 268. And effectively what it says, if you had preferred stock and that preferred stock had a change in control provision, then, and that change in control provision triggered redemption of that preferred stock, then you as a private company were allowed indefinitely to treat that security as equity, but if you're a public company, you have to treat it as a liability. All the FASB did was say, well, dang, that's creating a lot of pending content, this indefinite deferral, and so the FASB just said, let's make this indefinite deferral permanent and make it into a scope exception. So it won't change the accounting, but it just changes the way this is written in the code, and I would expect that FASB is not going to revisit this anytime soon. So those of you that are private companies, you can continue to keep your preferred stock that doesn't have a fixed redemption date outside of that mezzanine or liability treatment. And the good news here is that for down round protected instruments, you're no longer going to have to record those things at fair value. You still will, though, have to look at the other provisions of those instruments. Just because it's outside of down round doesn't automatically take you out of fair value accounting. There may be some other elements of that instrument that still put you inside of fair value accounting. And early adoption for this new standard is permitted, but keep in mind here that retrospective adoption is mandatory. So if you had some benefit running through your P&L in the past from a decline in fair value, then you've got to eliminate that and make sure that all those prior periods that are disclosed reflect this treatment on a go-forward basis.
Thanks, Matt. Time for polling question number 2. Again, if you're here for CP and you missed that first one, make sure you answer this one. Question is, determining equity versus liability treatment is one of the most complex areas of accounting. A. B. A piece of cake. C. Modestly difficult. D. None of the above. And again, make sure you get those answers in for that CPE. For those of you wanting copies of the slides, they will be sent to you. And we'll close the polls in 3, 2, and 1. Looks like most everybody got this right.
Yeah, I think it really depends on the type of instruments that you have on your balance sheet. It may be modestly difficult for some, but if you've got significant lengthy equity or debt agreements, it can often make it very complex. All right, so another standard, and this one I would put in the category of adding to some degree the complexity of accounting for, in this case, pension benefits, whether it be pension benefits in just terms of pure cash comp that you need to give to an employee when he retires, or health benefits to that employee. So it covers, the standard basically covers everything that falls under topic 715, which is effectively all defined benefits upon retirement. Effectively, right now, the FASB acknowledged that there's diversity in practice. If you look, the net periodic pension cost that appears in the financial statements is composed of a significant number of components. You've got service cost, you've got interest cost, which is basically interest on your projected benefit obligation, actuarial return on plan assets, gain or loss on plan assets, which really is just a result of the change in the projected benefit obligation from change in assumptions. You've got amortization of prior service costs. So a whole slew of things that are sort of buried into that net pension cost. And you know, the way companies were accounting for this, where they were categorizing that net pension cost in their P&L, was pretty varied. And effectively what this standard does is eliminate that diversity in practice and prescribe very specifically that you have to take the service cost component, and the service cost component is typically, depending on the period, it's going to be the most the largest component of your pension costs, and that is defined as the actuarial present value of benefits related to services rendered during the current period. And so effectively what that says is take the service cost component, and wherever that employee resides, so if you've got a research scientist and that compensation for that employee is running through your R&D line item, then you need to take a look at the service cost attributable to that individual and now make sure the service cost is running through the same line item. So again, in that example, the R&D scientist run his service cost component through there. Now all the other components of the net periodic pension cost are going to be required to be presented in the income statement separate from the service cost, and make sure that that is outside of your subtotal for income from operations. Another thing to consider here also, this standard does change the way that you are allowed to capitalize. In the past, you could take that entire pension cost, the net amount, and you were allowed to capitalize that as a component of salaries or compensation if you were constructing assets, whether it be a long-term asset or if you were capitalizing that as a component of compensation for inventory. Now under the new standard, you're only allowed to look at that service cost, and that is the only piece of pension costs that is eligible for capitalization. So for public companies, this is going to be effective after 2018, and for private and all other companies beginning in 2020. Early adoption is permitted. Keep in mind that retrospective adoption for this is going to be mandatory. That makes sense if you were doing an allocation of the service cost component in the past that doesn't line up with the future. Then for comparability, you want to do this The one interesting thing is that the retrospective adoption does not mandate that you rewind or unwind any amounts that you have capitalized in the past. And reading through the standard, in the footnotes, it talks through practical, expedient methods to arrive at this retrospective amount. And it doesn't really give any instructions, and in the guidance it specifically says we expect there's going to be some diversity. Basically do what is fast, easy, but makes sense. So again, for companies that have been taking the service costs and just including it in a single line item, keep in mind, and if you've been capitalizing those amounts, you will need to come up with some intelligent methodology to make sure that you're restating those prior periods for this adoption.
Thanks, Matt. We'll turn it over to Jeff.
Yeah, thanks, Matt. Sounds like a standard we're all excited to implement. Although fast, easy, and making sense is what we try to do. This next standard has quite a lot of meat on the bone. So this is ASU 2017-05. This was also recently issued by the board. This is one of the more robust updates that I've read through recently. It really focuses on how to account for the derecognition of non-financial assets, and we may wonder, why is that an issue? We see this come up a lot related to partial sales, specifically in the real estate industry. They're common in the real estate industry, and they can include transactions in which a seller retains an equity interest in the entity that owns the asset, or they may have an equity interest in the buyer. There was some significant concern about how an entity should account for these partial sales of non-financial assets when ASU 2014-09 was previously issued. The 2014 update was silent on how to account for these partial sale transactions, so the board came out with some new guidance to hopefully clear up all the ambiguity. So looking at some of the main provisions here, so what is a partial sale of a non-financial asset? It can include transfers of non-financial assets to a counterparty where in exchange you receive a non-controlling interest in the legal entity to which it was transferred. A parent company could transfer ownership interest in a consolidated sub that includes a non-financial asset, but they retain a non-controlling interest in the former sub. So you can see how this can get pretty complex pretty quickly. But this ASU requires an entity to derecognize that non-financial asset, which would then trigger a gain or loss through the P&L when a partial sale exists when a company does not have or they cease to have a controlling financial interest in the legal entity holding the asset, and they transfer control of the asset in accordance with Topic 606, which, as everybody knows, is the new RevRec guidance. Upon transfer of control, the non-controlling interest received in exchange will be recorded at fair value. If ownership is transferred but you still retain control, there's no derecognition recorded, and the transaction is accounted for as an equity transaction. So, for example, in that case, there'd be no gain or loss recognized. So, for public entities, this is right around the corner. This is for fiscal years beginning after December 15-17, and all other entities is starting in 2018. Early adoption is permitted, but only for annual periods starting after December 15, 2016.
Thanks, Jeff. So now a new standard talking about clarifying the definition of a business. And this ASU is codified under 805, which is business combinations or purchase accounting. And it's meant to narrow down the definition of a business, but beyond just purchase accounting, it also goes to circumstances when you are disposing of assets, and you have to take a look at whether or not that asset that you are disposing of is a business. And so again, why is the standard being rolled out? If you have gone through the evaluation of purchase accounting and trying to determine whether or not something is a business, you'll understand that the definition as it exists under Topic 805 is pretty broad, and if effectively it speaks to acquiring a set of items which constitute a business or potentially constitute a business. You take a look at inputs, processes, and outputs. And they just said the way this is currently written, including the definition of outputs, is much too broad. So they narrowed the definition of what is a business, and they started here with narrowing the definition of outputs. Right now, under the existing standard, anything is considered an output if it provides a return in the form of dividends, lower costs, or other economic benefit directly to investors. And they said, let's align the definition of outputs more with the new RevRec standard. And the RevRec standard obviously focuses on goods and services provided to customers. And the second thing they did was take a look at the notion of the processes that are acquired. So again, under the existing standard, you go out and acquire a business or an asset, and you, under that existing standard, have to take a look at your processes. And regardless of whether or not you acquired anything that can turn that input into an output, if you yourself have a process that can turn that input into an output, then that is, under the existing standard, going to constitute a business. So see here on first item, take a look at, they change the definition, and basically they say you now have to consider what are those processes you're acquiring, and those processes have to be substantive. So most commonly this is going to be a workforce that you acquire, employees that you take on board, and they're going to have to substantively contribute to the ability to take something that's an input and turn it into an output. And so the second part of the standard, they also said, let's make this easy. One of the most common areas that was falling into business combination that didn't necessarily make sense was the acquisition of assets. And so what they said, if you're going out and acquiring just a single asset or a single set of similar assets, and that constitutes substantially all that you're paying for, example being land or land and buildings with leases that are in place, then you no longer have to consider those as businesses. But you still have to basically take a look, okay, so now if you fall outside of that screen and now you are back into evaluating whether or not this thing is a business transaction, then take a look at the business processes that you're acquiring. Example that the standard puts forth here is an early stage company with no revenues. If you went in and let's say it was a biopharma company and all they had was one drug under development, maybe the entire company got disbanded and all you bought was the drug, the rights to that drug. Again, under the old standard or the current standard, you'd have to take a look at that thing and say, well, I've got maybe the people and processes in place to turn that development drug into a real drug and ultimately into revenue. Then in that case, you'd be forced to evaluate that thing as a business, which really doesn't make sense because all you're buying is an asset. So the new standard, again, narrows that definition and says take a look at the inputs that you have. And there's some great examples in the standard. I'd encourage you to read through them. It walks through and effectively says, it gives you an example and says you go out and acquire 10 houses that are leased. And if those 10 houses are leased, just because you're acquiring a house and leases, you first would fall into that screen and you would say, well, they're all similar assets and that's what I'm paying substantially all my money for, then you would fall out. And then the example walks through another scenario and says, okay, you're acquiring 10 leased houses, 10 leased buildings. Then that example walks you through and says, well, now because they're not similar assets, you've got dissimilar assets, a house in one case, a building in another. Now you're forced to look back to the standard and say, what are the substantive business processes that I'm acquiring? Again, one scenario walks you through and says, you're acquiring all the employees of that company that handle the leasing and the maintenance. In that case, it is a business combination, but another scenario, you're acquiring land, buildings, and in-force tenants under contractual leases and maybe even a maintenance agreement, but the standard in that example walks you through and says it's not a substantive process that contributes to the ongoing nature of that business. You haven't acquired leasing employees, you haven't acquired maintenance employees, you're not dealing with the operations of that business, and so that's not an example of a business combination. So I think the standard goes a long way towards simplifying and removing interpretations that wouldn't make sense, again, particularly focused on real estate or single asset acquisitions where it just doesn't make sense that it, under the existing standard, looks like a business combination and forces you into that accounting. So the good news here is that early adoption is permitted, and public companies need to implement this the beginning of January 18, and private companies beginning of January 19. Next standard, this one will take about 2 seconds to walk through. Restricted cash is appearing in the statement of cash flows. Right now, if you look, there are effectively two methods that you can do for handling restricted cash. You can either show it as a separate line item within your statement of cash flows, and you show the period-on-period change in restricted cash. The other alternative is you just lump restricted cash into your cash balances, and therefore it's appearing, you know, on the bottom of the statement of cash flows. And there was diversity in practice, and so what the FASB said is everybody should be doing it the same way. So now, under this new standard, you effectively take your restricted cash, include it in your cash and cash equivalents. So there will no longer be a separate line item showing the change in restricted cash. It's just part of all your other changes. The one enhanced piece of disclosure here to consider is that if you've got a number of line items on the face of your balance sheet that have restricted cash and it's not obvious, then you need to, in the footnotes, prepare a small table which shows how you are arriving at the balance of cash and restricted cash that appears on your statement of cash flows. The FASB doesn't provide a definition of what constitutes restricted cash or its equivalents, but I think it's pretty apparent that if anything that you're already showing on your balance sheet is restricted cash, then keep following that same methodology. Again, early adoption for this standard is permitted, and it's mandatory retrospective adoption, which makes sense because you want to have the same line items appearing in your statement of cash flows both in the current period and prior period.
Well, thanks, Matt. If you've made it to this part of the presentation, congratulations. You made it to the best part. You're going to get to hear about an update related to income taxes, which is always a crowd pleaser. So ASU 2016-16 was issued back in October, and it's intended to improve the accounting for income tax consequences of intra-entity transfers. And it's really been issued to bring GAAP more in line with IFRS, specifically IAS 12. And this was part of the board's simplification initiative to improve complex areas of GAAP. And as we all know, like Matt's alluded to earlier, anything they can do to improve those complexities are always welcomed, especially when it relates to income taxes. So current GAAP prohibits a company from recognizing current and deferred income taxes for assets that are transferred from one controlled entity to another controlled entity. The assets, it prohibits you from recognizing current deferred taxes until those assets are transferred or sold to an outside unrelated entity. Current GAAP has led to a wide diversity in practice and complexity in financial reporting, as this is really counter to the concept of what we know of comprehensive recognition of all current and deferred income tax items, in the applicable tax jurisdiction. Based on the revised guidance, though, a company will now recognize the income tax effect of any intra-entity transfer other than transfers of inventory, and that's important to note, at the time the transfer is made, rather than when the asset is eventually sold. So now management will need to be very careful here, as there's a lot of judgment involved needed to be applied to determine if the assets transferred actually do represent inventory. So what is considered inventory for the seller may not be considered inventory for the buyer, and thus income tax consequences may need to be recognized immediately. There are no new specific disclosure requirements as a result of this update. However, current disclosures may need to be considered and updated just to ensure they're properly reflecting the application of this standard with respect to the timing of when those deferred items should be recognized. So looking at the effective dates of this for Public entities, the ASU is effective for annual reporting periods after December 15, 17. So this is right here, right now. And then for all other entities, it's after periods beginning December 15, 2018.
Thanks, Jeff. We'll go to our third polling question here. We've got about 10 minutes left and a lot to get through, so we'll run this one pretty quickly. Which method of cash flow would your organization present? A, direct, B, indirect, or C, not sure? And again, for those of you wondering if you'll receive a link to the recording and the PowerPoint of this presentation, yes, you will. I'll be emailing it out to you within 48 hours. Let's get those answers in. We'll close the poll in 3, 2, and 1. Cool. And on to Matt.
Thanks, Deb. So this next standard speaks to 8 different items that are potentially appearing in your current statement of cash flows. You can take a look here. The items, I would say, are not that common, but you may be receiving these type of interest. The interest of time, I'm not going to spend time walking through each of these 8 items, because if you read the actual ASU, they will dissect each of these components further into its subcomponents, and then they dictate where in the statement of cash flow these line items should appear. So I would just say, in general, statement of cash flows is an area that is sort of always left last in the financial reporting process, and I would encourage you as preparers to work with your audit firm and take a look at these items and make sure that if there is if these are running across a wide variety of operating, investing, and financing activities, then you need to do what makes sense in terms of characterizing them in one of those 3 categories and make sure you're aware of this updated guidance. The effective date for these is running into next year, January 1st of 18 for public companies, and private companies January 1st of 2019, with early adoption being permitted.
All right, thanks, Matt. So as Debbie alluded to at the top of the presentation, there are some very robust changes related to the financial statement presentation for not-for-profit entities. I left this slide in here because I wanted to give you guys a link to our website. We have whole webinars dedicated to this one topic. I think you'll find everything you need on our website. Specifically, this link has some archived information related to it. So if this topic affects your organization, I'd highly encourage you to check out this link. Moving on to the next topic, liabilities and extinguishment of liabilities. So 2016-04 was issued a while ago and was contemplated by the board to address how to account for the breakage of prepaid stored value products. So breakage represents the amount that indefinitely goes unused by a cardholder. And so what is a prepaid stored value product? So if you're like me, you probably have about 15 of these sitting in your junk drawer in your office or in your house, each with a current balance of about 45 cents on it. These are products in digital and or physical form with stored monetary value on it that you can use for future payment or for goods or services. So think of like your Best Buy gift card. The question here is whether or not that prepaid gift card represents a financial or non-financial liability on the card issuer's books, because if it's considered a non-financial liability, it would be covered under the new RevRec guidance under topic 606. But 606 specifically excludes financial liability. So based on your answer really to this question, and apparently there's been a wide diversity in practice here, you could have a completely different accounting for the same types of transactions. So this is why we got the ASU, which hopefully clears it up. So moving through this quickly, under the new guidance, and as always, there are exceptions here, but under the new guidance, all liabilities related to the sale of these stored value products are now considered financial liabilities, and thus they are officially excluded from topic 606. So what does that mean? If management determines that the company is ultimately going to be entitled to some of the future breakage amount, the liability related to satisfying that would be reduced or derecognized in proportion to when the cardholder would exercise or expend their right of use. So in other words, if management has sufficient data to estimate that breakage will ultimately occur, kind of like in my example of those unused gift cards sitting in my junk drawer, maybe they've expired under certain state laws, they would recognize a reduction in the liability to satisfy those store value amounts over time, as that amount of the store value on the card is expected to be depleted by the card holder. So this reduction in liability can only be recognized if it's probable that significant reversal of that breakage will not occur in the future. Now, if management determines that they're not expecting to be entitled to any breakage amount, they then would de-recognize that breakage liability when the probability becomes remote of that cardholder exercising the remaining amount. So the effective dates are here listed. Again, this is for public entities and certain nonprofit entities and certain employee benefit plans. I've never come across a benefit plan that holds gift cards in there, so it's kind of odd to me. But this will be effective for periods beginning after December 15, 17, and then all other entities December 15, 2018.
Perfect. Thanks, Jeff. Our last, fourth, and final polling question. Are stored value products offered as a significant part of your operating activities? A, yes, B, no, or C, I have no idea. And get those answers in. We'll close the polls here pretty quickly in 3, 2, and 1. Looks about 80% say no. So.
Interesting. Jeff, you can send me those Starbucks gift cards if you like anytime. Financial instruments. All right. We've got exactly 4 minutes left. So again, the FASB is taking a look at this pronouncement. Effectively, back in 2008, when there was the global financial crisis, a lot of folks were complaining that the international standards were different from the domestic or the FASB standards. And that was creating great diversity in the way that companies were reporting and recognizing financial instruments. This standard really focuses on one area here. We're talking about equity investment securities. And not included in this is any equity investments where you hold greater than a 20% interest, that first threshold being 20 to 50%. Where you might be accounting for that as an equity method, or greater than 50% when you're accounting for that as under the consolidation standards. Basically, it says that if the fair value is not readily determinable, then you are to carry this equity security at cost minus any impairment. And that impairment assessment, you can be doing that qualitatively, similar to the way that you can do a qualitative assessment for any long-term assets that is currently held. If you do determine that impairment exists, then you have to calculate the impairment and recognize it similar to the way you did in the past. The good thing for companies that are reporting right now under the existing standards, you have to take that equity security and determine whether it's trading or available for sale. If it's trading, then you're running changes in fair value through your P&L. If it was available for sale, then you're running changes in fair value through other comprehensive income. But one of the challenges there is if you did treat it as available for sale and there was impairment, then you needed to look to that other than temporary impairment guidance in determining whether or not, in fact, you should be changing that value through OCI or the P&L. So effectively, it takes some of the guesswork and some of the decision-making out of the process and effectively forces all companies into uniform treatment. So you no longer need to look at equity securities under trading or available for sale categorization. And then also another part of the standard takes a look at securities carried at amortized costs, which would be debt securities principally held to maturity. Private companies, you no longer need to disclose the fair value of those amortized securities. In public companies, you need to continue to disclose the fair value, but you can eliminate any disclosure that you had around the significant assumptions used to calculate the fair value of that amortized cost security. There's some additional components of this ASU where public companies, it's been clarified, have to use the exit price notion, so that takes into account the price to sell a security. Right now there's some diversity in practice where folks will use an entry price notion for securities. And so again, it was creating inconsistency in the way the same security was being reported by different holders of that security. And then finally, there are some additional disclosure requirements that have been added under this new standard. That's basically, we're going to require you to disaggregate investments that you hold and show them by measurement category. So if they're held under fair value, if they're held under amortized costs, and further dissect those into the form of financial assets, the example here being securities or loans and receivables. So you're going to have to separately take a look at the tables that you prepare related to the instruments that you hold and make sure they follow those new standards. And so these new standards do have some good tables and examples, so make sure you take a look at those. And for public companies, this is going to be effective immediately next year. Private companies going into 2019 with early adoption permitted.
Thanks, Matt. We're going to wrap this up. During today's webinar, we've analyzed the impact of recently issued ASUs, reviewed the background, highlighted the insights, and reviewed kind of when companies need to adopt and apply each of these standards. We obviously run out of time for some questions. If you've got any, please feel free to submit them, or you can reply to the email I'm about to send, or you can contact one of our presenters directly. Their information's there on the slide. You'll be receiving the recording and the slides within 48 hours, and we look forward to having you at a future Armina webinar. Thank you for joining us, and thanks to our presenters.